Kia ora and welcome to the New Zealand Herald's Budget Day special. It's great to have your company this afternoon. Nicola Willis says this is a no BS budget. So let's keep this simple. We're here to find out where the government's going to spend our money. We know the operating allowance is being chopped, so where are the cuts? The other bits we're looking for this afternoon, 1 is the growth forecast, 2 the deficit track, 3 KiwiSaver, what changes can we look for there, 4 pay equity, what are the savings from that policy, and 5, of course, any surprises will be across this afternoon. The big questions, will this budget help or hurt economic growth? And how deep are those cuts? Will they hurt everyday Kiwis? Shortly, we'll be taking you live to the Finance Minister's budget address in the House. Our Wellington business editor, Junaid Tipshrani, has been in the lockup this afternoon. She's heading to our live position at Parliament. We'll be with her in just a second. Our guests, Thomas Coughlan, Herald political editor, you'll know him. Fran O'Sullivan, NZME's head of business, of course. Simon Bridges, the former Associate Finance Minister, and now with the Auckland Chamber of Commerce. There's a bunch of other economists and experts, but we'll come to them later in the program. We'll also hear from the opposition parties this afternoon to gauge their reaction. We'll be bringing you coverage over the next hour right here at nzherald.co.nz. Kia ora, good afternoon and welcome to the program. It is 1 after 2, so the lockup is finished and we can tell you a few things about what is in Budget 2025. The big thing is pay equity, just how much the government is going to save. So we know $12.8 billion over the forecast period. $12.8 billion over 4 years is a massive number, and actually that is half of all of the cuts the government is making in this budget, totalling $21.4 billion. Half is from pay equity. So that is a significant number and a significant move from the government. A $6.6 billion, this is the good side, if you're in business, tax incentive for businesses. So this will allow you to deduct up to 20% of a new productive asset's value on your tax return if you are in business. Treasury has increased their unemployment forecast, reduced their wage forecast. Before we get to Wellington, we're going to go to Junaid Tipshrani, who's our Wellington business editor, who's at Parliament. Before we do that, we're going to get to Fran O'Sullivan, New Zealand Herald's head of business, and Simon Bridges, CEO at Auckland Chamber of Commerce, of course, former National Party leader and Associate Finance Minister. Good afternoon.
Afternoon.
Good to have you guys here. Fran, your initial assessments?
Pragmatic.
Simon?
Yeah, I think pragmatic, and I think from a business perspective, we were talking about 6 a.m. this morning. The reality of it is people will have their views on the pay equity, but at a level there's been a switch there into the productive side of the economy, incentives for business. In the end, I think they're taking the view that the only way you sustainably grow wages is by growing the economy, and with these tax incentives, they're trying to do that.
It's a hard sell. Will it be a hard sell politically? Because those tax incentives will take a while to have any effect on growth. At the same time, you've got this headline, Fran, about women are paying the price for businesses getting, you can see that narrative.
Yeah, I can. But if you don't get growth in the economy and start employing people, it's going to be very difficult anyway. What I would like to see at some stage, what the impact of deferring those pay equity imposts are. And maybe are they gone forever? We don't know. Maybe they come back again when the economy has got more growth into it. I think they need to talk about that at some stage. But tax incentives to get going for business, particularly at the smaller end of the town, are desperately needed in my view. So I think that's all good.
And it worked in Australia. We know that with the accelerated depreciation there, businesses started investing quite rapidly after the change was made.
And I think, look, I'd say from a business perspective, this seems excellent. I was prepared to come along here and say I was disappointed because we hadn't seen any of these things. But actually, I come away saying, no, that's not true. Can they sell it? Well, actually, we've seen governments in the past sell tax switches and various other things. You've got to consistently make the argument and have your numbers and your rationale lined up. But I think New Zealanders are reasonable people. If they can see this is about getting growth, getting the economy going so that their kids stay in this country, country, and maybe there's pay equity down the line when we can afford it. I think those are arguments that can be won.
Yeah, the other aspect I really liked is KiwiSaver, just that pushing up the contribution rate.
Yeah, we're gonna actually see how the government is selling that. We're crossing live now to the House. Nicola Willis begins her Budget Day address.
Green Party of Aotearoa, New Zealand.
15 votes opposed.
ACT New Zealand.
11 votes in favour.
New Zealand First.
8 votes in favour.
Te Pāti Māori.
The ayes are 68, the noes are 49. The motion is agreed.
Appropriation 2025-26 Estimates Bill, first reading.
The Appropriations 2025-26 Estimates Bill is set down for second reading immediately. The Honourable Nicola Willis.
Mr Speaker, I move that the Appropriation 2025-2026 Estimates Bill be now read a second time. Ahumairangi, tangi te keo, tu te ao, tu te pō, te whanganui atara, te karu waitai, piata maina. Kei oku nui, kei oku rahi, nōku, te honorei, ki te whakamunu, i te tahua, mō te tau nei. Tēnā koutou katoa. Mr Speaker, as I said in Te Reo Māori, it is an honour to announce this year's budget. This is a responsible budget to secure New Zealand's future. It supports the economic recovery now underway. It also takes a longer-term view, with initiatives to boost future investment, savings and growth. It continues this government's investment in health, in education and law and order. And in a challenging global environment, it provides funding to boost New Zealand's defence capability. And it does all of this within an expenditure track that reduces government spending as a share of the economy, returns the government's books to balance and bends the debt curve down from going up to going down. The economic outlook presented alongside this budget is a bright one. After a tough few years, growth, jobs and wages are set to rise. The government is not promising that today's budget will solve all New Zealanders' problems. But we do promise that the decisions we are taking now will set our country up for a better future. Mr Speaker, the creation and delivery of an annual budget is at the heart of strong and stable government. And this budget is a team effort. I want to acknowledge and thank the Associate Ministers of Finance, David Seymour, Shane Jones and Chris Bishop, for their ideas and their advice. They were heavily involved in putting this budget together, as was the Prime Minister, whose leadership and wise counsel was invaluable. Thank you, Prime Minister. Mr Speaker, in recent years, New Zealanders have battled through an extended period of high inflation, high interest rates and low growth. And we know that times remain tough for many Kiwis. The good news today is that with strong economic and fiscal management, our recovery is underway. The recovery is being supported by lower interest rates and strong export performance. And over the next few years, the government's new investment boost policy, which I will come to shortly, will have a positive impact on growth. Recent tariff announcements have created uncertainty and volatility around the world. And for a small trading nation like New Zealand, the global situation is concerning. It doesn't threaten the recovery, but it does threaten the pace of the recovery. The Treasury has pegged its forecasts back and downside risks remain. Despite this, budget forecasts show economic growth picking up to healthy levels once again. Real GDP growth is expected to accelerate to 2.9% in the next fiscal year and 3% in the year after. Growth matters. It means more jobs, higher incomes and opportunities for families to get ahead. And over the forecast period, wages are expected to grow faster than inflation, and at the end of that period, there are expected to be 240,000 more people in jobs. Mr. Speaker, the government's books have taken a hammering over the past 6 years or so. Spending has risen sharply, so has government debt. The budget deficit left by the previous government is structural. It is not simply due to the state of the economy. In other words, the last government was living beyond its means, loading up the credit card to pay for things New Zealand couldn't afford. And this did real damage to our economy, as a massive spike in the cost of living led to high interest rates and low growth. This government is taking responsibility for cleaning up the mess. And under our fiscal management, government debt will stabilise, then start to come down. And our control of spending creates room for monetary policy to respond with lower interest rates. There is no doubt, Mr. Speaker, that fiscal consolidation is challenging. Some would do it with higher taxes. Well, that would burden New Zealand workers and businesses and scare away talent and investment. It would put our economic recovery at risk. This government is taking a different approach. We are getting the books in balance by controlling growth in government spending. The operating allowance for budget 2025 is $1.3 billion on average per annum. This is the lowest allowance in a decade, significantly down from the $2.4 billion allowance signalled in the budget policy statement in December. That reduction of $1.1 billion goes straight to the bottom line. The government's headline operating balance indicator, OBGAL-X, is $1.1 billion better each year on average than it otherwise would have been. And in addition, the Treasury estimates that the tighter budget package will see interest rates being 30 basis points lower than they otherwise would have been by the end of the forecast period. Importantly, that $1.3 billion allowance is a net figure. On the one hand, it encompasses $5 billion a year of new investment and $1.7 billion a year for tax reductions through investment boost. On the other hand, it contains savings of $5.3 billion a year. Now, these savings are the result of ongoing efforts by multiple ministers, and I want to acknowledge you all today. We take seriously our roles as custodians of taxpayer money. A significant portion of those savings come from changes to the pay equity regime. The changes were made to ensure future settlements stick to correcting pay discrepancies that arise from sex-based discrimination and not for other reasons. Making those changes means the government can repurpose $2.7 billion a year on average towards budget priorities like health, like education and law and order. That $2.7 billion had been put aside in contingencies for what, under the previous regime, were expected to be very wide-ranging pay equity claims, increasingly divorced from the sex-based discrimination that pay equity is supposed to be about. A one-off $1.8 billion has also been repurposed from previous contingencies and put towards capital expenditure in this budget. supporting investments in new hospitals, in new schools and other infrastructure. And I can assure members that adequate funding remains in contingency to meet potential costs of future public sector pay equity settlements under our new regime. And the government also anticipates there will be pay rises in female-dominated public sector workforces achieved through normal collective bargaining. Mr. Speaker, the government has also been able to find net savings by increasing funding for inland revenues compliance activities. Funding of $35 million a year is expected to result in $280 million of extra tax revenue. That's an 8-to-1 return on investment. This was an initiative proposed last budget by New Zealand First and expanded in Budget 2025. Further savings have been made by closing a number of tagged contingencies and from reviewing the value of money, of grants and funds across government. This is not austerity. In fact, it is what you do to avoid austerity. Because getting the books in shape ensures New Zealand has financial security and choices into the future.
That's right.
And as I am about to set out, savings in this budget have allowed us to make much needed investments in health, in education, law and order and rebuilding our Defence Force. Budget forecasts show that core Crown expenses are expected to remain steady, then decline as a percentage of GDP, reaching 30.9% by 28-29. The Obergalex deficit is expected to widen in the near term, then gradually improve after next year, returning to a surplus of $200 million by the end of the forecast period. At that point, members, the structural deficit the previous government left us will have been eliminated. Net core Crown debt is expected to peak at 46% of GDP, slightly lower than forecast at the half-year update, before then beginning to decline. As these forecasts show, Mr. Speaker, the government is taking a deliberate, medium-term approach to fiscal consolidation. I am aware there are alternative approaches. Some say we should keep borrowing forever, whack it on the credit card and hope for the best. Well, that would be the height of irresponsibility. It would put the financial security of New Zealand at risk. And we owe better to our kids. And to my own kids, sitting in the gallery today, I want to say that I know Mum's been busy lately, and I'm sorry I missed your show last night, Hatter. But your future and the future of the next generation of New Zealanders has been very much on my mind as we've put this budget together. Yes, well done. This budget will be good for you and for all our kids. Mr. Speaker, New Zealand's productivity challenges are well understood. Study after study has identified that a low level of capital investment per worker compared to other countries. To raise productivity, to lift incomes and drive long-term economic growth, New Zealand needs our businesses, big and small, to invest in machinery and tools and equipment, technology, vehicles, industrial buildings and other capital assets. Investment Boost is a new tax incentive that will increase capital investment in New Zealand. An Investment Boost allows a business to immediately deduct 20% of the cost of a new asset from its taxable income on top of depreciation. This means a much lower tax bill in the year of purchase. And the remaining book value is depreciated at normal rates. Since a dollar now is more valuable than a future dollar, the cash flow from investments is more attractive and the after-tax returns are better. More investment opportunities will stack up financially, so more will be made. Over 20 years, members, investment boost is expected to lift New Zealand's capital stock by 1.6%, our GDP by 1%, and wages by 1.5%.
Sounds like Mike Hosking slam you. Your statement.
You're watching the Herald now's. You're watching the Herald's coverage. We're not quite with Herald now of Budget 2025. A couple of other things have come through just in the last couple of minutes. So the KiwiSaver subsidy, if you contribute to KiwiSaver and you get the maximum subsidy, it's $521. That's being halved to $260. It's been means tested as well at $180,000. So anyone earning over that won't get it. That'll save them $2.5 billion over the forecast period. Your best start payment, that's going to be means tested as well. Student loan threshold will be frozen. Labor's come out with their press release saying it's austerity, austerity, austerity. Simon, how do you think the expectation of this budget has been managed?
I think they've done a very good job. I mean, it's early days, but you look at it, they've set the expectations very low. We thought it was all austerity, austerity, austerity. They got the stuff about pay equity out there, now probably a bit clumsily, but they did that. And people like me are sitting there saying, well, yeah, I agree with, running things lean. It was overdone by the last government, but you can take that too far. But then what we've got actually is quite a lot of substance in this that's new, that we hadn't seen. So in an expectations management sense, that's fantastic. $6.6 billion in tax relief, which shows those business people we've been talking about have been doing it tough. Actually, they do get it. There is something there. They are trying to provide some incentive and some confidence. And I think the key line actually is from Nicola Willis, this is what you do to avoid austerity. If she can prosecute that case over coming months into the budget, they could do very well.
Fran, going forward, we've got cuts to KiwiSaver here to the government contribution. We've also got an optional go to 4% of your earnings. What are you making of that? And also this talk more generally about NZ Super, this budget.
Well, I think it really does need to move to that, where a bit of user pays, a bit more means testing. We've got opposition, obviously, from New Zealand First, leader getting on in age, getting a decent cabinet minister's salary and still getting super, which would probably be about 15k a year. But these are the issues that we need to talk about. And I think apart from moving the age on, it's going to go from 23.2 billion to 40.5 billion in 10 years. That is a massive whack to the economy. I would hope that the same pragmatism that this budget has contained, even though they have actually, got this 12.6 billion out of the pay equity fund, effectively, that they actually move and open a dialogue between the two main parties and start to get some common sense so that actually further out we are providing for people appropriately.
Well, Winston Peters won't be getting the government contribution to KiwiSaver any longer because it's been means tested as of this budget. 23 minutes after 2 now, we're going to go to Wellington. Janae Tipshraeny is the Wellington business editor. She has been in the budget lockup and joins us now. Janae, good afternoon.
G'day, Ryan.
Yeah, good to see you. Tell me, you've been in the lockup, you've read all the documents, you know more than us. What surprised you? What's jumping out at you from this budget?
Well, I think actually, fortunately, this budget was, as was signalled, or as we guessed here at the Herald, we were sort of playing the guessing game ahead of the budget. The two main things, I think, as you've discussed, the biggest new initiative of spending beyond health is this tax support for businesses that invest in new plant and equipment. The idea here is that businesses can write off the cost of new investments they make in new technology and tools and so on. So that will reduce their tax bills.
Thanks, Fran.
That saving for businesses will be material. And the way that is being paid for is by changing the pay equity regime, which has been well discussed. Today, the thing we found out was that would cost workers or save the government about $13 billion over the forecast period. To me, this is a bit of a true blue budget. The government is empowering businesses, trying to get them to stimulate the economy. That is partly coming at the expense of workers, whose pay rises will be limited. There's also a bit of a pay your own way sense here. So with these KiwiSaver contributions, the government is cognizant we, as employees and also our employers, need to do more to help us save for our retirements. The government is not going to be there to help as much as it currently is.
They're not saying you have to do that, right, Janae? They're saying that's an option for you.
It sounds like for now it's going to be the default, but there will be an opportunity to keep your contribution at 3%. We'll have to see how it looks further down the track. You know, I think the thing that I'm looking at here is this time the pay equity regime is sort of what saved the government, which freed up billions of dollars for it to spend on new initiatives like this tax support for businesses. The push will be what happens next year, because the fiscals are still not looking great. There is no surplus in sight, so that's over the 4-year period. The books will not return to surplus, they will stay in deficit. Debt to GDP is continuing to rise. It should come off towards the end of the 4-year period, but is not coming down. The government's bond issuance, that's the debt issuance, that is still high. You know, the question will be, what does it do to get the books on a more sustainable pathway forward? Should we decide as a country that's what we want? What I'm looking at is changes to ACC. That might be next year's big thing, next year's pay equity kind of saviour ahead of the budget.
All right, Janae, thank you very much for that update. Lovely to have you on the program. That's Janae Tipshrainer, who's our Wellington business editor, with us live from Parliament. So the big story, I suppose, the unexpected story perhaps, or at least the size of it, is this depreciation change for businesses. So if you're in business and you're buying new machinery, new assets, you can depreciate 20% of the value on your tax return. That's going to cost $6.8 billion, I think it was. Now, Treasury estimates, this is in the budget, the depreciation changes will actually lift growth, which is what you want. This is exactly what the government has been trying to do and what Nicola Willis has been at pains to talk about. Will lift growth, GDP, by 1% and wages, because remember, you get productivity, you get wage growth, you get real growth, lift wages by 1.5%. But that lift takes place over 20 years. So half of that growth will occur in the first 5 years, but it will take another 15 to get the other half of it. So I guess the question for the government is, yes, that is fantastic that you are doing this, but politically, because the payoff is so far in the future, does the risk of what you are cutting, whether it's students, whether it's KiwiSaver, whether it's pay equity, in the short term, does that hurt you more than the long-term game? The other question, I suppose, is what are you in politics for? I mean, you're there to presumably to try and change the economy, to reorganise things so that we get growth now and into the future. And it looks like that is exactly what Nicola Willis is trying to do. Joining us now, Trish Sherson, political commentator. Trish, welcome to the program.
Hi there.
Good to see you. And Simon Wilson, senior journalist at the Herald. Good afternoon.
Hi there, Ryan.
Trish, I'll start with you. What's your takeaway?
Well, as ever, this is a budget where there's happiness and sadness all at the same time. The key word for me from Nicola Willis was actually fiscal consolidation. That's her term for saying, I'm not going as far as austerity, but this is another year where you're going to have to all sit down and take your medicine. There are some very clear trade-offs, and I think that the balance the government is really trying to strike here. Think about the criticism that they have faced, particularly this year, where there's been a widening gap between actions and words, particularly around their growth mantra and what it actually means for business. So your point around the tax incentives for depreciation is a good one. It's a long-term payoff, but it's also a very important signal for business to be able to start growing and investing. We've got a huge lag in terms of what's actually happening in the economy and where the government wants this to be. So that is very true that yes, it costs the government a bit, it'll be a long-term payoff, but it does really help businesses right now.
Yeah. Simon, what is it? I mean, obviously there is a cost to doing this. This is $6.8 billion. And we've learned that half of the savings, the overall savings that the government's making in this budget have come from pay equity.
Yeah. So this is, I think, a remarkable measure that you're right. The idea that 1.5% growth over 20 years is a significant addition to the strength of the economy. It looks like window dressing to me. It looks, frankly, farcical. The government has not been able to produce so far anything really significant to say this is how we are genuinely going to grow the economy.
To be fair, the finance minister did say this is not the magic wand.
Okay.
This is,
well, clearly.
Which would be hard to do with $6.8 billion over 4 years, right? But she is saying this is the direction. This is what we can do now with what we've got.
Well, I think if you put it in the context of the cuts to pay equity, which are twice as large as that, as you just mentioned before, if you're talking about direction, then let's talk about things in which we will be able to say we are building a higher wage economy that will make the country and the economy more functional, more able to cope with the technological and other demands that are coming at us at a great rate of knots. Taking out the pay equity claims is a retrograde step on that. Saying to business, we've got a plan for you, but it's only going to be a 20-year plan and we'll get hardly any growth at all. That's not really going to do it.
Okay. Trish, what do you make of that? Because, this is the argument from Labor, you're robbing Petra to pay Paul and all this kind of stuff.
Yeah, well, I think as hard as this budget has been to put together for National, this is an incredibly hard budget for Labor and their side of the House to argue against, because really they don't have a shred of economic credibility still, and we are now paying for the mistakes that they made over 6 years. The pay equity thing really interests me from a timing perspective. Given the quantum of savings found for this budget have come, from my read of it, have come from pay equity.
Yeah.
That only happened, remember, in the 11th hour. So was that the government's plan all along to have to rush that through at the 11th hour? And what would they have done if they couldn't have found those savings?
What this tells us is that David Seymour was absolutely right when he said that Brooke Van Velden was saving the budget.
Well, I think it was clear that Brooke Van Velden was doing something for the budget that was going to make it possible for Willis to hold her head up and all that. That's true. But when you say that the opposition doesn't have any credibility, I mean, they'll speak for themselves. But we are talking about a situation where in housing, in health, in education, in infrastructure, the economy has been floundering badly. And we are in a desperate situation now in this country because there hasn't been the kind of economic management that will find a way through those problems.
From who? Who are you talking about?
Well, I think from both governments, frankly.
Okay. Well,
and I don't think we're seeing it this time.
The sad thing for us is we're going to have, by the time we get back to surplus, we would have had 9 years of deficits.
Well, why is that
which
a sad
is longer?
We have one of the lowest deficits in the OECD.
Yeah, but we're highly exposed on private. We're highly exposed on private mortgages that the Aussies own. I mean, there are lots of reasons why we need a lower debt to GDP ratio than other countries around the world. But and by the way, this is we were getting to 46.5%.
I think that's a mantra of the National Party and ACT. I don't think it actually holds up in the real world. We could have higher levels of debt, and we could be addressing the really serious problems we have faced in healthcare and elsewhere.
Beyond 50%.
Well, we're not anywhere near 50%.
Well, we're going to get to 46.5. Yeah. This is on Haven.
I think there's 2 quick points on that. One is on the social contract side, which Simon is talking about. That is still the biggest risk area for this government. The problems in health are still out of control. The problems in education, they haven't been solved and they won't be solved by this budget. But thinking these days that budgets are going to be transformational in an MMP system, I think that's completely unrealistic. Budgets, because, and particularly we're in an unusual situation of our first 3-way formal coalition, budgets now are a very carefully negotiated document, and they include the tensions between ACT and National, ACT and New Zealand First and National. So they're not going to be transformative.
That's a comment on the wider economy and economic policy, isn't it? Not just the budget.
Yeah, that's right.
Yeah. One quick point. This is from Labor, who've come out and said, and this is an interesting one. If you're a young person there and you've got a student loan, they're freezing the threshold, so you're going to end up paying more on your student loan. Well, repayments will be higher for your student loan than they otherwise would be because normally it adjusts for inflation. But the other thing that they've come out and said that Christopher Luxon's decision to cut the government KiwiSaver contribution will steal $66,000 from the retirement savings of your average 18-year-old entering the scheme today, which is an interesting way to, I mean, I suppose once you start adding things up, but yeah, again, if you increase your contribution, you don't get the government contribution. Maybe it works out about the same by the time you retire.
One of the strongest things about the New Zealand economy, in my view, is that we do have a KiwiSaver, and that KiwiSaver is over time going to be something that makes a real difference to the economic health of generations way past mine, and it should not be undermined in any way. It should be strengthened.
Yeah, I mean, look at the Aussies. I think they've got about $4 trillion in pension funds.
And I'm old enough to remember when we had a few weeks of having one of our own under Muldoon. Until Muldoon came along and scrapped it.
Yeah, and I agree. I don't really like the fiddling with KiwiSaver, particularly for young people when it's a way to get them into it. And I completely agree with Fran that actually the big elephant in the room, and still this budget hasn't addressed it, maybe it's going to be addressed at the next election, is actually our superannuation bill. And it's part of New Zealand's, part of us taking our medicine is particularly people in our generation. I include Simon and I, not you, Ryan. But us being really upfront and saying, look, we will have a KiwiSaver. We have to be prepared to give up some of our superannuation. We have to move the age. And in my view, we have to get to a position like Australia where it's means tested, because we cannot afford what's coming down the pipe.
And that goes to your point before about the difficulties of coalition politics, because this current coalition is not going to agree on that. So it will go to the next election, and it will be a fiercely contested issue at that point.
All right. Trish Sherson and Simon Wilson in the studio with me. We're going to go now to Thomas Coughlin, who's the Herald's political editor in Wellington. Thomas, good to have you on the program as well. This is a really, when you strip it down, this is a blue budget, isn't it?
Cuts to things like the KiwiSaver subsidy. You've seen the student loan repayment threshold held. That's going to mean that every dollar that a young person earns above that threshold, they're going to pay 12 cents in tax additional that they wouldn't have paid if they'd lifted that threshold, which the last government did every year. You've got the Best Start payment cut as well, or means tested. So you've got all these sort of social spending initiatives that were started under Labor in various forms. They've been winnowed back, and that money has been ploughed into this pro-growth investment tax credit, more than $6 billion. It's designed to bring forward investment. Nicola Willis said, citing Treasury advice, that's going to supercharge the economy. We're going to get a bit of economic growth over the next few years that we wouldn't have otherwise had. That growth is going to filter down into wages and the employment market. So, in that sort of summation, that synopsis, you really see a right-wing kind of economic playbook, pulling back on those state supports, dialing up the pro-business tax regime, and then hoping it trickles down. This is a real return to sort of trickle down, I guess.
Do we know, have we got any data on what type of assets they're talking about, business assets they're talking about in terms of purchases? How many businesses might be eligible, or is it everything up to 20%? What is it exactly?
I spoke to some people in the lockup. I haven't seen the bill yet. It sounds like it's physical assets. There was some discussion around assets like software, but from what I understand, it is physical assets. But I can't confirm that yet. I haven't seen the bill, and it is only a 20% deduction, not the full 100%, which there had been some talk of a little while ago. But as Nicola Willis said on Monday, that would cost tens of billions of dollars every year.
Yeah, a bit pricey, that one. What about the growth side of this equation? You mentioned that this is the idea, but it's going to take a long time to get it, right?
Well, yes. I mean, we've got Treasury estimating a 1% additional growth thanks to that tax change. Now, if you were to look at that generously, it does take a lot for Treasury to say, look, thanks, Finance Minister, because of that we're going to update our growth forecast. Treasury basically never does that because it likes to be on the conservative side of things. So any growth that they estimate as a result of an initiative is positive. But it's 1% over 20 years. So, I mean, I look forward to doing this show in 20 years' time, 2045, Ryan, and we can talk about how great things are then. But it's really not exactly an election winner. 1.5% wages growth over that time as well. But again, 20 years. One thing they did say is that additional growth, that additional wage growth as well, is going to be front-loaded in the first 5 years, so that is positive, I guess. But at the same time, when you look at that investment credit, which obviously does, it means that there will be more growth and more wage growth than otherwise. But when you take in the whole economy, Treasury has actually downgraded our unemployment forecast, so we're going to have higher unemployment than otherwise. We're going to have another year of unemployment above 5%. That's really high for New Zealand, and we weren't expecting that in the last Treasury forecast. I think they were 4.8% unemployment for this year, so that's been upgraded. They've also downgraded wage growth expectations, so wage growth is now expected to be lower than it was expected to be in December. And then on the other side, again, pointing to the fact that this really is a true blue kind of budget, one area where they have upgraded forecasts is house price growth. So you're going to see higher unemployment, lower wages, but house prices sort of are roaring back into life. So it really is a return of that kind of style of economy.
What about growth? How has the forecast changed? I'm just looking at the HAEFU from December. 0.5% for 25, 3.3 for 26, 2.9 for 2027. What's Treasury updated? I can't have the exact year-on-year comparison, but Treasury does see, I believe in the coming year, a 3% GDP growth, and it does stay around that 3% level. In fairness to the government, Treasury did downgrade its forecast because of Donald Trump's Liberation Day tariffs. There was a section in the BFU about what it had done in relation to those to that economic uncertainty. So I guess while these forecasts are not as good as anyone would like them, really, they are better than they would have been otherwise, because obviously the Donald Trump effect has weighed on the economy, and no matter what this government did in this budget, we would have had a much worse set of books, mainly because of the Americans pummeling the economy. So I guess these pro-growth things have meant that the economy is not great, but it is more great than it would have been had they not happened. But you're really splitting hairs there, aren't you? Yeah, absolutely. It's crazy how quickly that whole Trump Liberation Day tariff thing happened, and then markets have already come back. We've got deals being signed, and a pause. Thank you very much for that, Thomas. Great to have your analysis.
These forecasts are probably out of date.
Yeah, you're not wrong. It's like trying to whack a piñata. Trying to predict where growth is going to go, which is so reliant on what Trump is doing. It's like trying to whack a piñata with a blindfold on while drunk. Anyway, Thomas Coughlin at Parliament for us. We're going to hear now from Matthew Hooton, who's a New Zealand Herald columnist and political commentator. He was inside the lockup, and we recorded this with him.
What was your initial reaction to the budget delivered today?
Well, debt is going to increase by about $60 or $70 billion over the next 4 or 5 years, both in gross terms and in net terms, and that's worse than was expected in December. So the government will be borrowing just like it's always been borrowing, and we're heading towards that point where we won't be able to borrow anymore.
So you would argue that there needed to be a lot more savings in this budget than what Nicola Willis has produced?
Until the government is prepared to cut superannuation and tertiary health care, basically this country is heading towards bankruptcy. None of this takes into account the problems that we've known about for 30 or 40 years that kick in from 2030. We're going to start that period about 50% of GDP worse than we expected at the end of the era of reform under the Bolger, Shipley and Clark governments.
Nicola Willis would be quite constrained in terms of superannuation. She's got a coalition partner in Winston Peters who doesn't want to see that age increase. Was there anything she can really do in that area?
No, probably there's nothing Nicola Willis or any government can do, but people should know that things just continue to get worse and worse in New Zealand. The cost of our debt servicing is going to reach $12 billion at the end of the forecast period, but that's based on heroic assumptions about our borrowing costs. It's based on New Zealand 10-year government bond rates being at 4.3% next month. There's no possibility they will be that low, and to stay at 4, and then to be at 4.3% through the forecast period. As we continue to borrow, as we have the Trump administration wrecking the world economy, there's no way that our debt servicing costs will be only the $53 billion over the next 5 years that Nicola Willis is forecasting. We'll be paying much more than that in interest over the 5 years. The only good thing about the budget, I suppose, is that it would be worse, much worse under a Labour government.
And just quickly on the tax incentive announcement today, the investment boost, helping businesses that buy new equipment try and write off some of that in their tax bill. What do you make of that? Is that going to be attractive to businesses? Is it going to make any real difference?
The business boost, the investment boost package, 1.7 billion, seems like a sensible move, and we're going to get about GDP will be 1% higher in 20 years' time than what we expect it to be today. So that's a good move. It's the main investment boost. I think we can comfortably say that most of the other things, like the 75 million for Invest New Zealand, will completely fail, as you know, as all initiatives of that nature have always failed in the past. And I think we can also say that the so-called cost of living relief will itself cause inflation.
That was Matthew Hooton. Always a cherry chat with Matthew, isn't it? But interesting what he's talking about, the debt servicing costs. He says that the assumptions in how much it's going to cost us to service the debt are quite heroic. I want to bring in Liam Dan, who you will know from the Herald, business editor at large, and Christina Leung, who's a principal economist at NZIER. Good afternoon, guys.
Hey, Ryan.
Thanks for being with me. Liam, I'll start with you. Are there heroic assumptions here about how much it's going to cost us to service debt?
Well, maybe optimistic. I mean, you'd hope Treasury was realistic, but I guess when you look at what, say, happened overnight with US tariffs and now Trump's plan to sort of cut taxes and trying to get that through, push bonds, US bond yields up to, I think 30-year highs I saw. So you know, and it happened earlier a couple of months ago when he was trying to push the tariffs through. So there's this upward pressure on bonds and borrowing costs and the cost of money. So, you know, the Treasury and the Reserve Bank, you know, are unwilling to sort of bet on what's going to happen, because how can you? Because Donald Trump is changing position all the time. So it's not guaranteed that it's a heroic assumption, but it might be. It could be, you know, it could be that the borrowing costs blow out. Yeah.
Christina, what are you thinking about what you've seen so far?
Yeah, so in terms of the forecast, brought like as expected because of the revisions from the Stats NZ historical data, we've got the, in terms of that downward revision to near-term growth, but then over the longer term, it's broadly in line with where we have it. Similarly for inflation, the fact that with the lower New Zealand dollar, that's boosted up tradable inflation. So in the near term, it does provide that upward boost, but then over that longer term, you would expect that we're going to see that continued easing in inflation. So overall, not really much in the way of surprises there in the forecast. Which is probably a good thing, given all that's happened in the world. Well, yeah.
So with the OCR, you're saying you don't think this is going to have much of an effect on that track, that, you know, a lot of economists think it'll get down to 3 by Christmas, or perhaps even down to 2.75 or 2.5?
So when assessing what the implications are for interest rate outlook, it's important to look at the fiscal impulse that's in the forecast. So that goes, what that shows, the fiscal impulse shows, is just how much policy that are within these, in the budget today, how much that either stimulates the economy or contracts from the economy in terms of inflation pressures. And what we're seeing with the fiscal impulse is that it's a bit mixed across the projection in the budget. So stimulatory for the coming year, but then a bit more contractionary in the following year. So we don't actually see that as having a material impact in terms of changing the interest rate outlook. We continue to see 2 further cuts in the OCR over the coming meetings to bring the OCR to 3%. And I would say that it's more the global, what's happening globally. Those will be the bigger forces at play in terms of influencing the interest rate outlook.
Liam, were you surprised at the size of this tax incentive for businesses?
Yeah. I mean, I'm maybe. Like I thought they'd underdeliver. You know, that it would be. So yeah, they've really bet big on this. When you look at, say, they're still calling it a growth budget, and Nicola Willis is defending against the idea that it's an austerity budget. What's the big growth, sort of
lever
here. Yeah, it's this, and we always talk about productivity and New Zealand's low productivity, and this is one of the long list of things that we say that New Zealand underperforms in, which is the quality of our investment and the amount of investment in capital. So that our companies don't have the latest robotic technology and all that sort of stuff. So this should encourage them to invest more and be able to expand and improve the quality of the equipment and capital equipment. Plant equipment and that sort of thing, so our workers will be able to deliver more. And so it's a long-term thing. Look, let's hope the theory works, because it's a great theory. I've always supported it. And you look at Germany or somewhere, and they have really high productivity, and they have the most amazing factories full of incredible machinery.
And Australia did this, right? They did an accelerated depreciation on new machinery and plant technology, and it had exactly the effect that you're talking about.
Yeah, I mean, it'll have a stimulatory effect as well, because I guess you can give money back into the ordinary New Zealanders' pockets, and they can go and spend it at the shops. We can give it to business, and they hopefully will reinvest it in the company, and so the tax they get back will be stimulatory to some extent. And I guess that's a national government betting that that's the engine room of the economy, and that's what you want to do.
And David Seymour, Christina, has spoken about, even before the budget was announced, which he probably shouldn't have done today, but the fact that this is not about the government trying to grow the economy. This is about handing the reins over to business to grow the economy for them.
So fiscal consolidation has been the clear theme in this budget. When it comes to productivity, we've done quite a bit of work, NZHERald have done quite a bit of work for ASB and also Spark in terms of looking at the drivers of productivity. And so, sure, tax in terms of support for businesses, that's useful. But when we look at what the three key drivers are, one of them, the main one, is the fact having an ecosystem. So the fact that you have got an ecosystem across research institutes, government sectors, and then also private sector, so that you can be easily, so that new ideas can more easily be commercialised, and you have that ecosystem. That's very important. The second key factor is actually exposure to international competition. So the fact that when firms, they're having to compete in a more cutthroat market, being exposed to, and that's when you push firms from the domestic to the global frontier when it comes to innovation. So that's a very key part in driving innovation, because you're forcing firms to have to compete that much harder in the international markets. And then the third one is the fact that when firms are motivated to innovate, that they have minimal barriers to do so. And so that's where access to finance and also minimal regulatory barriers become very important.
Okay. We're just hearing that the Labour Party finance spokesperson, Barbara Edmonds, is going to join us in a few minutes' time, so we'll get to her shortly. Liam, the unemployment forecast is up and wage growth forecast is down. What do you make of that?
Well, that's, I guess, that core inflation continuing to come out of the economy. So if because when unemployment rises, there's more slack in the labour market, and the wages come down. So, I mean, that's expected. That's up until a sort of a peak later this year, and then hopefully things might start to turn around, and we could see unemployment come down and wages going up. But it sort of has to happen from the ground up, and the government certainly is taking that view, that it has to come from the businesses stimulated, businesses investing and hiring more staff and the economy growing. It can't come from the government putting more money in. But look, they're going to solve the unemployment, some of the unemployment numbers with that policy on the 18 and 19-year-olds. That's quite a big one, actually. They're saying no more dole if you're 18 or 19. So
I haven't even got to that.
Well, yeah. So
Please
this is a policy that I think it says something like parents taking responsibility for, unless you get married, there'd be one way around it. but so if you're 18 or 19, you've got to get into study, or you've got to have a job, or no more jobs, no job seeker allowance, and that's pretty big, right?
That is big.
Yeah.
But I mean, it'll be popular with a certain part of the population.
I can see the incentive. Why they would do that, and they would say, well, look, just go and study. If you can't get a job, if the market's bad, upskill. And so hopefully they make the pathways easy for that. But there are people, there are people in communities where, culturally that isn't the thing. Communities where unemployment's really endemic, where it could actually be a real tough tough thing in the short term.
Yeah, is it potentially a bit of a fishhook when you've got unemployment being forecast to go up, and at the same time you're saying, hey, if you are in that position, then
it'll be something for the economists and the statisticians to work into their equations when they look at that labour force survey and all that sort of stuff.
Yeah, so what we're seeing at the moment is because firms, with that still continues soft demand, firms are still very reluctant when it comes to hiring. So, as Liam says, it is a lot of it comes down to those alternative pathways. Okay, so if they can't access the dole, what is the alternative in terms of, are there jobs for these people to go to?
Yeah, absolutely. Liam Dan and Christina Leung, great to have you on the show this afternoon. We are going to get to Parliament shortly with Labour's Barbara Edmonds, but first here from the lockup is the economist Cameron Bagrie with his take.
First big takeaway from the budget today.
Well, I guess we always knew this was going to be a budget that was all about Peter and Paul. And yeah, we saw the pre-election announcements where Peter was getting a whole lot of initiative spending. Today we found out who was Paul in regard to how it's all going to be financed and who's paying for it.
Yeah, and who is Paul? Who is the program or the initiative paying for everything?
Well, there were savings coming out of clamping down on KiwiSaver contributions from the government. The big money earner for the government, the money saver, obviously came out of the pay equity, a little bit more revenue initiatives on the other side. So the government pulled a rabbit out of the hat in order to save this budget because the pay equity saved them an awful lot of money. But looking forward to the next sort of couple of budgets, I think the government's going to need to pull more rabbits out of the hats.
Yeah, so I think it's $21 billion over the forecast period is being saved. How is the government going to be able to keep finding that money in savings, or is it going to have to increase debt?
I think it'll be increasingly difficult going forward. If you look at what's called the structural deficit, the government's underlying fiscal position is still deteriorating for another 12 months. Yeah, so we haven't actually seen the real tightness flowing through the economy yet. That's going to flow in 2026, 2027. Yeah, so today was a little bit, I guess, the appetizer on the main course because we're going to need to see some pretty frugal budgets over the coming few years to go from deficit to surplus, or as debt goes up.
There's also in the budget the announcement of this investment boost to help businesses with their equipment and their assets and writing some of that off in their tax bill. Do you think that's going to help businesses? Is that going to help economic growth in the country?
Yeah, well, in the near term. But ultimately we want to get real substantial growth going forward. We've got to have a big discussion about productivity growth. And productivity growth across New Zealand used to average 1.4% every year. For the last decade, it's been down to 0.3%. Yeah, that's a structural problem that I think is going to take a number of years to turn it around.
Is there anything in this budget that's going to help turn it around? What would you like to see moving forward?
Well, the government is in what we call the impossible trinity, where you've got these competing demands. You want to go from deficit to surplus. You've got to pour money into infrastructure because we've got infrastructure deficits. You want to try to give a little bit of tax relief, and then we've got pressure on core government services. And it's pretty tough to make the numbers add up when you've got those 3-4 competing objectives. And today I guess it was a little bit about the balancing act, but that balancing act was made a lot easier because they found those savings coming through the pay equity arrangement. The savings I think are going to be difficult to generate with this upcoming budget, so look around and see where we're going to find those rabbits out of the hat.
That was Cameron Bagrie, economist in the lockup at Budget 2025 at Parliament. He says the government pulling a rabbit out of a hat. Was David Seymour right when he said that Brooke Van Velden was saving this budget with the pay equity changes? Joining us now is Labour's finance spokesperson Barbara Edmonds, who's at Parliament. Barbara, good afternoon.
Good afternoon, Ryan.
Hey, what are you calling this budget?
Women are worth less budget.
Do you think the government knew ahead of, how far in advance do you think that they planned this? Because half of those savings have come from pay equity. Was David Seymour right when he said it was saving the budget?
David Seymour was absolutely correct. He was the only one telling the truth that working women have now saved the budget to the tune of $12 billion. So he was absolutely correct. And hard-working women across the country now will be earning less in the future because of these government's choices.
What do you think of their tax changes, though? You must support encouraging businesses to invest, which grows wages and grows the economy.
Absolutely support businesses growing their businesses. However, does it have to come at the cost of women? The government also made choices to give tax cuts to multinational companies, tax cuts to tobacco companies, tax cuts to landlords. This is all coming off the back of hard-working women.
You seem quite angry.
I feel incredibly disappointed. We have had women here in Parliament who have been asking to be paid what they're worth. And this government has basically slammed the door in their face and has said to them, you're not worth it, but multinational companies are worth it, tobacco companies are worth it, gas subsidies are worth it, but you're not. So I am disappointed and I am angry on their behalf.
Do you concede, because there's been a lot of back and forth over this on the last couple of weeks, do you concede that not all of that $12.8 billion contingency would have, well, first of all, would have been spent, but second of all, not all of that would be down to pay equity issues, that there are other factors at play in a labour market?
Budgets are always about choices, Ryan, and this government has clearly said those pay equity claims that they've cancelled, 33 of them gone, those are the women who help you when you're pregnant, who help you when you have a young child, and who care and support you in your last days of your life. We are now saying to them that you're not worth it. However, gas subsidies are worth it, tobacco companies are worth it, landlords are worth it, multinational companies are worth it. That's not the society where we value people who care for us.
Would you get rid of this tax incentive for businesses?
Today is about the government's budget. We're going to be going through it line by line in the next few days, and we will provide our alternative and our fiscal plan.
Yeah, so you're saying, sorry, I missed your answer to that, Barbara. You were saying you're not making a call on that today. Today's about the government. But one of the problems that Labor has is your messaging on what your debt to GDP ratio would be versus your leaders' reckonings on what your debt to GDP ratio should be. There's a lot of stuff in here that costs money. You've said you'll restore the pay equity. Well, there's, $12-13 billion. If you don't keep this, or if you do keep this, there's another $7 billion. Where is Labor at with its debt?
Budgets are always about choices. So when our fiscal plan will come out, we will look at the balance sheet as a whole. That includes expenses, revenue, debt. But today is about the government's budget and what they've said to women, hardworking women across New Zealand, that what you're paid is not worth it, and we're going to take that money and give it to other people who probably don't need it as much as you.
All right, thanks so much for that. Barbara Evans, who's Labor's finance spokesperson with us from Wellington. Really appreciate your time this afternoon. Just a note for those who are watching and just joining into our live stream at nzherald.co.nz, we will continue, we will finish shortly, but the Prime Minister Christopher Luxon and Nicola Willis will be giving an address at 3:30 this afternoon, so that will be live streamed at nzherald.co.nz. I've got Liam Dan and Christina Liang in the studio with me. If we maybe some final reflections from you both. Liam, we've just heard from Barbara Edmonds, who says, expected lines, I suppose, from them. This is austerity. Women are paying for these tax incentives for business. It's hard-working women that this has been, that's basically paying and saving this budget.
Yeah, well, that's going to be a big target, and I'm not going to defend the government on this one because I've got into arguments with this, and with women, and I lose. It's a tough argument. Whatever you want to say about pay equity, it's not a politically a good look, and so I think the government's hoping that things will move on, but it has obviously created a lot of money, and there's a simple formula. The opposition's going to say money from women to business, and it's pretty emotive, but I'm optimistic that we can grow the economy, and that I think they're at least doing something that may actually help grow it. They're doing a little bit on the savings side with KiwiSaver. I'd like to see them do more. I'm sort of a pro-compulsory super savings guy. So I would, they could have gone further there. But I guess it's a step in the right direction. And maybe as New Zealand gets more used to it, you can't take that much money out of people's pockets. But in Australia, they're up to like 12% matched by employers or something, and they've got $4 trillion. And we ask why they're richer. Well, they save more money. Look, there's some stuff there that is quite positive. Finding the money was from some contentious areas, and that's going to be a political battle.
Christina, what do you give this budget out of 10? If you had to.
Generally, I think it's a pretty boring budget, to be honest. It really highlights the trade-offs at play. And economics, it's all about trade-offs in terms of where the priorities are with the government. This really highlights. And they've been clear that a lot of it is around reprioritisation, the fact that with fiscal consolidation being a key theme of this budget, and that's what they've played to in terms of the policies that they've come up with today.
Right, I like that. A nice, honest, boring from you, Christina. Really appreciate you guys coming on the show this afternoon and giving your analysis. Liam Dan, the business editor at large at the New Zealand Herald, and Christina Young, who's the principal economist at NZIER. It's just after 3 o'clock. We are going to finish up now, but at 3:30 you can return, well, you can stay with nzherald.co.nz, of course, but there'll be a new live stream starting at 3:30 with the Prime Minister, Christopher Luxon, and the Finance Minister, Nicola Willis. A true blue budget from National for Nicola Willis's second budget. Big tax incentives for business in there, most of that quite unexpected, certainly the extent of it. And just the fact that we knew pay equity was going to be billions, but $12.8 billion over the forecast period, half of the savings that the government is finding in this budget have come from pay equity. We'll leave it there and join the live stream from 3:30 if you'd like to. Until then, catch you later.